Hey everybody, Anton from IntellCRE here. Welcome to this quick tutorial on how to use the value and financing section in the new analysis form. Now, this is perhaps one of the most important sections where we are actually able to price our deal. We're able to confirm whether the price of the deal is going to work for us. We can look at sales comps. We can factor in our financing scenarios. We can look at sensitivity, and we can basically declare what our assumptions are around the acquisition and the sale or eventual sale of this deal. So let's jump right into it. So the very first subsection are our sales comps, and there's a couple of ways how we can have the system, how we can get the sales comps into the system. We can click quick suggest, in which case our AI algorithms are going to pick the best relevant sales comps for this market. So similar properties that were recently sold that fit a very similar profile to our subject property. Other method is to import our comps, so we can import a whole library of comps or create comps individually. And the last method would be to actually go and open the map view, and of course choose some filters that we want to use. We can use map features such as drawing a polygon to denote or isolate a specific neighborhood where we want to look for comps, and then just going over the results and the comps that we want to work with. We simply click the plus icon to select or the minus icon to exclude, so they're not cluttering our view. Once we've selected our sales comps, these are going to be listed here in the selected comps tab. And once we're done selecting the comps, we click save and close. And this is our sales comp set. Now note that any sale comp in the sales comp set, we can edit the data. So let's say I call the broker and I know the cap rate at this deal. So I can, let's say it's 4.9. So I hit the pencil icon and I simply include that data point there. And then I hit update values. And now I have my cap rate in for this deal. And now there is an orange icon on the sale comp, which is signalizing that this is my comp or the comp that I've edited myself. Now, after we have our sales comps, we can look at the averages, specifically our average price per unit. And we can also look at our subject property. So in case that there is the listing or a whisper price, and we've included it in further up in the analysis form when choosing the buy use case and having the listing price here, or whether we're pricing the deal from scratch. So we're in the sell use case, and we haven't included that information there. Now, the sales comps are being used by the system in order to show us the price estimate for this property. So we don't need to do the math. The system is doing the math for us and is showing us a range, in this case between 4.3 and 4.8 million, of where this property should sit given the sales comps in the market. Right below the sales comps, we see some charts, and we see that the profile of these comps is very similar to our subject property. So we should be pretty confident about the fact that we're using good sales comps. Now, in the section below our sales comps, we find our acquisition and sale assumptions. This is how the section looks like before we enable advanced options. After we enable advanced options, we have certain assumptions about the acquisition date, our working capital, acquisition fee. We can add any closing costs related to the acquisition. And then on the sales side, we have other assumptions such as the hold term, right? So depending on the hold term or how far out we want to model this deal, our closing costs, we can switch between the percentage or the total value, right? And we also have assumptions around the exit cap rate, which this is very important for the investors, probably the single most important assumption that we're making. Basically, what the cap rate, what the exit cap rate is going to be for this deal, 7 years down the road or 5 years down the road. And for this purpose, we have several calculations that you can use for the exit cap rate. You can use the rule of thumb, which is basically how institutions usually model deals. So we look at the pro forma cap rate, which we can see on the right sidebar here, regarding that as some sort of stabilized cap rate for our deal. And then we add an increment of 0.1 to the cap rate for each year of the whole term. So in this case, that ends up being 0.7 added to 4.18. So 4.48 is our exit cap rate. So this is the rule of thumb method. The second method is manual. So I can just we can use the cap rate of our own taste. And the third method would be IntellCRE AI, which is our own proprietary algorithm where we look at historical data, similar properties in the same market that were traded several times over the past, say, decade, and then trying to extrapolate what the pure appreciation in that market is, and then based on that appreciation, model the exit cap rate. So if we choose the IntellCRE AI algorithm in this case, we see that we get a slightly more accurate number here. Now, for the exit value, some model the exit value for their deal by considering the 12-month NOI after the sale. So if we're doing this modeling this deal for 7 years, they would look at the NOI in year 8 and use that together with the exit cap rate to calculate the exit value. Some tend to use the last 12 months of NOI in our hold period. So they would look at the NOI for year 7 and use that number. So you can switch between pre-sale or post-sale NOI that is being used to calculate the exit value. Now, as I mentioned, and as you can see here, we have our price estimate based on comparables enabled. If we don't want to use it, we can disable it, or we can re-enable it. And now there is one more algorithm that we can use for the pricing of this deal, and that is going to use the cap rate. So given that we know that similar properties in this market are trading at a certain cap rate, we can enable the minimal cap rate algorithm, and we can play with the purchase cap rate in this case, and we can see how that is being reflected in the price of the building. So if the if the market cap rate in this market is 4.1, then given the operational data for this property that we have included in the income section, in the expense section, now there's an NOI, there's a pro forma NOI, and these numbers are being used together with some sort of minimal cap rate for us that we want to see at this deal in order to generate the price for this deal. So we're between 4.1 and 4.5. Right, the comps are telling us that we should be between 4.3 and 4.7. So if we have both of these algorithms enabled at the same time, the colorful price estimate is going to be showing us the optimal value. So we should be between 4.2 and 4.6 million, with 4.4 being the optimal value. Right? If we're buying, we want to be on the lower end of this spectrum. If we're selling, we want to justify and be on the higher end of this spectrum. But this is basically giving us a lot of insight into how much this deal should be worth, given what the market is telling us, both in terms of the cap rate as well as the sales comps. And we can, in fact, have this reflected in the property value. Of course, we can override all these numbers. So I might want to look at how this deal looks like at a 4.2 million, right? I can do so, and then look at my return metrics and all of that on the right sidebar. I can look at my decision criteria, which we can preset in the platform settings, and I make sure that this deal is passing all my decision criteria. So I see all green lights, meaning, okay, this is probably interesting. This is something we want to spend more time on. But you can also click set to estimate here in order to basically set the property value to be in line with this price estimate here, right? So at this very view gives us a lot of insight, because we're seeing what the deal should be worth based on the comparables, what the deal should be worth based on the minimal cap rate or average cap rate in the market. And on the right sidebar, we see all our returns and metrics, such as GRM, cap rates, cash on cash, return on investment, return on equity, IRR, equity multiple. And we can make sure that this is actually something that's passing our criteria, and that this is or would be passing criteria for our buyers in case we're the ones selling this deal. And we want to find, and we can find the equilibrium, really the optimal price for this deal, or what the price should be. So of course, hovering over some of these numbers, such as cash on cash, we can see what the cash on cash is year by year, whereas this pro forma is going to be our annualized cash on cash number, annualized over the entire hold period. Now, a very important point to stress here is at the very bottom of my screen, you see there's income totals, expense totals, financing cash flow. If we click on these, the bottom panel will roll out. and we can grab the panel by the upper edge and move it upwards and downwards. So we can have simultaneously the view of the analysis form, and we can be editing the numbers, and we can also be checking things like our detailed cash flow down below. So any number that we change here, we're going to see that being reflected in the cash flow analysis down here, and we can either look at the monthly or on the annual version. And here we see each year what our cash on cash is, what our return on equity is, and so on. So after we've priced our deal, now it's time to factor in any financing that we're thinking of doing for this deal. So is there an existing loan? If so, we simply enable the existing loan here, define the terms for the existing loan, things like remaining term and so on. And then we're going to use, and we're going to model the situation of assuming a loan. Now, one very important point that we need to stress here is that whenever we're using an existing loan, so we're buying this property and assuming a loan, let me just use an example here. Loan term 6. Let me just use an example here. So there is a certain remaining principal payment on the loan that we're assuming. And if we are buying this deal with this existing loan, although the property value is, say, 4.4 million, that's not the acquisition or the equity that we need in order to do the acquisition, right? So what we want to do in this case, when we're using existing loan, is we want to use the acquisition cost field. So this is basically your acquisition equity, or equity required for the acquisition. And what we want to put in here is our property value minus the remaining principal here, right? So I'm just gonna round the numbers up. So let's say this is 1.98. So acquisition cost is going to be 4.4 minus 1.98. So I'm going to put some number here as my equity that is needed in order to make this acquisition. And this is going to work out well for us, okay? So careful about this point. And now, what if we have a traditional acquisition financing for this deal? Then we basically enable acquisition financing. And here is our interest rate, amortization, loan term, loan fees, interest only period. We can switch between years or months, depending on how granular we want to be. And on the right side, we have our LTV, our loan amount, down payment, and our DCR. Of course, this calculation can be automated so that you're seeing what the maximal LTV is given the financial numbers for this deal. So in this case, it's 44%. And of course, this is considering the target DCR of 1.25, which most traditional lenders would want to see, right? We can, of course, start increasing or decreasing this number, and the other numbers will recalculate accordingly. And the same we can do for the LTV. So if I want to look at how this deal looks like at 40% LTV, the DCR is higher. Loan amount, down payments are both changing, right? So if we want to do a seller's financing or some other creative financing scenario, we can simply click seller's financing. And in this case, what's the monthly payment going to be without interest? When is the first monthly payment due? And then, of course, the balloon payment and other things will be, and amortization will be calculated automatically from those numbers. If we want to do this as a proposed financing, so we're selling this deal, we're not saying, this is the loan that you're getting, but, this is how the loan would look like. We can even customize the name of this. So let's say this is a hypothetical loan, right? Or something like that. Okay, if we're all cash buyers or we don't want to use acquisition financing, we simply click do not use. And of course, once there is a loan there, either existing or acquisition, we can also use the refi by saying when the refi is going to happen, what's the cap rate for the refi, and things like that. What's the fee for the refi and things like that. If we want to model any bridge loans or any additional financing or anything like that, we can use the additional financing. And of course, this is just going to be without the DCR, right? This is just going to be a loan amount, down payment, and this is going to be offset, right? So depending on when in our whole term we are thinking of doing this additional financing or bridge loan, we can model that here. So that's everything regarding the financing scenarios. And now sensitivity analysis, it should be part of our value and financing section. So we can do, and you will find the results of the sensitivity analysis down here in the bottom panel. And so let's say we do sensitivity analysis with respect to exit cap rate and the purchase price. So what this means is that we're making some very important assumptions in the underwriting. and we want to look at if some of those crucial assumptions have been slightly different, or the reality is slightly different. So the exit cap rate is not 4.9, but it's 5.15, right? How would this deal look like in terms of the exit, the return metrics and the exit value and so on, right? So this is precisely what's happening here. So we have the 4.9 is the exit cap rate that we're working with, and here we're seeing the sensitivity. So if it's slightly higher, so 5.15, 5.4, 5.65, how would that change our numbers? And then also going to the left, if it's slightly lower, right? And the increment for these steps here is basically 0.25 up here, right? And we can change the increment. We can even change the number of steps if we don't want to have 7 different scenarios, but only 5 or 9, right? So we can play with the number of steps here. Now for the purchase price sensitivity, we have a certain property value here, 4.4, and we can look at how this deal would pan out if this was slightly higher or slightly lower. In the same fashion as with the exit cap rate, we have the sensitivity with respect to the purchase price down here. And of course, the sensitivity analysis that we choose to enable here, later on when we're building the report for this property, we're going to have the option of including that sensitivity in any of our reports. So just want to make sure that it's enabled here. And finally, we have an option to model an equity waterfall. So if we're doing a syndication, a real estate partnership for this deal, there's an LP that comes in with a certain percentage of the equity, the GPs, sorry, then there's LPs that come with a significantly higher portion of the equity. We can define our waterfall acquisition, asset management, and waterfall disposition fees that are usually paid to the GP by the LPs. We define our hurdles. So as with any equity waterfall, the GP is promising a certain minimal return in terms of the IRR, project level IRR. So let's say we're promising a minimal return of 8% IRR. So that is the first hurdle, or the preferred return. Right, and there is no GP promote or no promoted interest for the GP in case that the project underperforms or performs at the 8% IRR level, right? So the way the cash flow from the project would get distributed among the LPs, among the GP and the LPs, would be precisely given by this equity split. So 5 to 95 split, right? But the moment that the project performs better, so it actually hits higher returns, higher IRR, let's say IRR between 8 and 11, we're entering hurdle 2, where suddenly the GP has a promoted interest because they did a great job. The project is performing better than the minimal returns. And what happens is that any cash flow, any dollars that are above the 8% preferred return, these dollars don't get distributed according to the original GP LP equity splits, but now the split shifts slightly. And how it shifts is reported down here. So if we're in hurdle 2, the GP promoted interest is 20%. So 20% out of the 90% of the LP, of what should have been the LP profit, now goes to the GP. And so the GP, so the split for the cash flow in hurdle 2 is 24% for the GP, 76% for the LP, right? And in a similar fashion, if the project performs even better and we enter hurdle 3 with higher GP promote, now the GP and LP cash flow split shifts further, in favor of the GP, and then in hurdle 4, further and further in favor of GP. And so the result of this is that there's a project level IRR, which in this case is 12.23%. Which is great because our minimal target is 12, so this is better. And this would put us in hurdle 3 already, right? In this real estate syndication. And so the result of this deal would be that the LP is going to have an IRR of 11.46, which is far better than the minimal 8, right? But it's slightly lower than the project level IRR of 12.23. And the GP's IRR is almost 23%. And so also here we have the equity multiple for the GP, for the LP, and this is the promoted interest that the GP would earn because of this deal. So that's pretty much it. Finally, if we want to include any narrative for the deal or any comments, like we're using these sales comps, but they're slightly nicer than our property. That's why we're actually going to work with a slightly lower price per unit for our property than the sales comps are telling us. Any comments like that, we can enter them here, and they're going to be a part of financial assumptions page once we generate the report. So after we have all of this, we can proceed to creating the deal. Now, I hope this was helpful. And if you run into any questions, feel free to use the support icon here to let our team know. And I'll see you in the next tutorial.